We invested in Shell when the oil price was about $30 because we saw the opportunities for the upside in an oil price appreciating market, but also because they'd just done their BG acquisition, which allowed more levers to be pulled within the business. Also, in the current environment, we see that Shell have put more rigour into cash returns to shareholders compared to BP, who have just announced an acquisition to acquire BHP's oil assets in the US. Therefore, we see Shell as committing to its cash returns to shareholders and also benefiting from the oil price. Intermediate Capital is growing itself as a large specialist asset manager with just under 33 billion euros under management. It has long-term objectives and investments into private equity markets, real asset markets, and therefore enables high returns to its investors. It's able to generate more and more cash through these funds, which have long, good vintages and have growing yields. BBA is a fixed-base operator in the US, primarily on refueling private jets and servicing the other needs of those customers. Over the last 2 years, it's done a big acquisition, which we believe will generate higher returns as they expose themselves to a greater part of that market and offer more and more services to get a greater spend of the market that is out there. You can never say no, but a yield of 7 to 8% or higher normally tells you one of two things about a company. Normally it is completely undervalued by the market and therefore should appreciate in value, or that the distribution for that company is wrong. If you look at the market, Debenhams has been yielding above those ranges for the last 2 years. But fundamentally, we believe that the end market is structurally challenged because of the move online and where it's positioned its footprint. So you have to look at the fundamentals of the underlying company before deciding to invest. It's not just a decision on yield. The dividend outlook remains positive for the FTSE market. This is driven by the fact that the major companies who deliver that yield tend to be HSBC, the oil companies, pharma, and tobacco. These companies, however, are driven by the FX rates. Therefore, a weak sterling has benefited them and the distributions they can provide to the market. Therefore, one of the major risks is where the sterling market goes, and a strong sterling would potentially reduce the yield on the market. However, when we look down the FTSE all-share market, we see that there is continued growth in the mid-cap region with companies able to deliver higher yield moving forward, and therefore we remain confident on the outlook for dividends. We continue to believe that the bottom end of the FTSE 100, top end of FTSE 250 normally deliver the best returns and best best yielding companies we can provide. This is due to the fact they are slightly undercovered, but also that they are able to grow into their end markets and continue to distribute both high growth returns but also capital returns to clients, delivering you the best total return.